Welcome to SIRA MCQ YouTube channel. Today we discuss advanced level A-level accounting paper 2025 question number 24. What is the question number 24 requirement? Inventory turnover ratio based on closing inventory. The basement is closing inventory. Closing inventory. Why? We know cost of sale dividing average inventory. We use must be why? Closing inventory. They said that based on closing inventory and interest turnover ratio. Firstly, we identify inventory turnover ratio. How can we calculate it? Inventory turnover ratio. This is the ratio. Inventory turnover ratio. Turnover ratio. How can we calculate inventory turnover ratio? Cost of sales dividing average inventory, but they said that get what inventory based on closing inventory, therefore we use to line closing inventory okay, closing inventory. Inventory means inventory. Okay, inventory. Okay. Inventory. Look here, we must find the what are the cost of sale and closing inventory. Cost of sale is there. Look here the question, cost of sales. Look here, for the year ending 31st March 2025, cost of sale 4,500. We can easily get 4,500. We must find the closing inventory. Are there any closing inventories there directly? Total assets is there, current asset is there, equities there is not related to inventory, income tax expenses, return on equity ratio, debt to equity ratio, quick asset ratio. The closing inventory should be identified as asset. Okay, asset. At that point, closing inventory should be included in current assets. You know current assets. Current asset include closing inventory and other assets. In that point, we can identify what is, look here, their quick asset ratio. Based on the quick asset ratio, we must identify other things. Look here. Why? Look here, current assets include inventory, closing inventory. Current asset equal closing inventory. There is a quick asset. Quick asset is there. Quick asset doesn't include closing inventory. Okay, in that point I can prepare an equation of current asset. What are they? Closing inventory plus quick asset. Why? The quick asset means without closing inventory. Quick asset means without closing inventory. There is no including of closing inventories there. Therefore, quick asset should be added closing inventory. We can identify the current assets. At that point, we must identify quick assets. There's a quick asset, there is no information. Therefore, I use the quick asset ratio. Okay, quick asset ratio. Next point, I find quick asset ratio. Quick asset ratio. Quick asset ratio. How can we identify the quick asset ratio? Quick asset is there. Quick assets. Look here. Quick asset is there. Quick assets. Dividing in current liabilities. Quick asset ratio is there. What is the quick asset ratio? Quick asset ratio is 1.25. 1.25. Okay, look here, this is the flow. We must identify the inventory turnover ratio. To inventory turnover ratio, we identify closing inventory. You know, closing inventory is there. Closing inventory include in current assets. Therefore, the current asset is there. We can include current asset is there. Look here, current asset 3000. The current asset is 3000. We find the closing inventory. The closing inventory is not there. After that, we find the quick asset. Okay, quick asset is not there. Therefore, I use the another ratio to identify the quick asset. Quick asset ratio I use to quick asset. Why? Quick asset is there. Based on that, we find the quick asset. Okay. After that, the quick asset is no example. I use the Y for quick asset. We must find current liabilities. What is the current liability? Look here, there is no information about current liabilities. To find the current liability, I use another information. You know, current liabilities, another page. You know, total liabilities, total liabilities. Total liabilities include current liabilities and non-current liabilities. Total liabilities is there. Look here. How can we identify total liabilities? We can find 31st March 2025. Total asset must be there. Total equity should be there. Asset minus equity. We can find asset minus equity 9,000. 9,000 is total liabilities. Sorry. Liabilities. Why? Total assets are include equity and liability both. Therefore, I total asset deduct the total equity. I can find the total liability 9,000. Total liability 9,000. I can apply there. Total liabilities. We find the current liabilities. Why? There is a current liability to find the quick asset of the business. Therefore, the current liability we find firstly non-current liability. To non-current liability finding, I use the another ratio. You know, non-current liabilities are the long-term liabilities. In that point, there is a non-current liability is debt capital. Okay, Non-current liabilities are debt capital. Look here, debt capital. Debt capital should be identified. There's a debenture, debt capital. Therefore, look here, there's a debt to equity ratio is there, 60%. Therefore, I use the debt to equity ratio. To find the non-current liabilities, I use debt to equity ratio. Debt to equity ratio. Equity ratio. 60% is there, 60. Debt capital is there, debt capital. Debt capital. Debt capital means non-current liabilities. Okay, debt capital means non-current liabilities divided in equity capital. Debt to equity, equity capital. Equity capital. Equity capital. Debt capital means there is a no, we don't know the debt capital. The equity capital we know. What is the equity capital? Equity capital is there. Equity capital is equity. Look here, there is equity. Total equity is 12,000. 12,000 is there. Please find the x. X means debt capital is multiplied by 120. 7,200 is debt capital. Debt capital. Therefore, I use the non-current liability as a debt capital 7,200. 7,200. This is the another ratio. 7,200 is a non-current liability debt capital. Therefore, I can identify this one. 1,800 is non-current liability. Sorry, current liability. Therefore, I use the current liability 1,800 as to quick ratio. Therefore, I can find the quick asset based on that. Multiplied by this one, 125 multiplied by 18. We must find the calculator. Okay, we find the calculator. Calculator is there. What is the multiplication? 125 multiplied by 18. Answer is 2y 2,250. 2,250 is y. Y means quick assets. Quick assets. Quick assets. We can use to find the quick asset. Quick asset is 2,250. 2,250. There is a quick asset. 2,250 is quick asset. Therefore, we can find the x. We minus this. We get this one to here. 2,000 minus 2,000, 3,000 minus 2,250 is 750 is x. X means closing inventory. Closing inventory. Closing inventory is 750. 750 is there. 50 is there. That point we must divide this one. This one. Okay. 450 divided in 75. Answer is 6. Answer is 6. Answer is 6. Therefore, inventory turnover ratio is 6. Inventory turnover ratio is 6. Inventory turnover ratio is 6. We can find 6 is there is a 2 answers. Inventory turnover 6 and this one is 6. Okay. The interest coverage ratio should be identified. Interest cover ratio. What is the ratio? interest cover ratio. Interest cover ratio can calculate this time. Interest coverage ratio, profit before tax, add total interest divided in total interest. We firstly find the total interest. Total interest should be identified based on long-term liabilities. There is one long-term liability is debentures. What is the price of debentures? Debentures is this one, non-current liability. There is one debenture is there, this one, 7,200. Why? This question said there is no non-current liability. Only we have debentures. Look here, there's top of the question. They said that on the same date, debenture with 5% annual interest were also issued. There were no any other long-term liability in the company. There is no any other long-term liability. Therefore, on debentures, only like a bank loan, is only non-current liability. Based on that, we can find the interest, 5% annual interest. Therefore, we can find the annual interest. Why? The debenture should be issued in opening day. Therefore, we can find the interest. 5%. 5% means 360. This is the total interest. We can identify the total interest 360. There. This is the total interest. This is the interest. Okay. After that, we find the profit before tax. How can we calculate? You know, think about the income statement. The income statement, the final area means not the top area, this is the following area. Look here, the after the income statement calculate, you find this time profit before tax. After that, you deduct total income tax. After that, you find profit for the period. At that time, you find the profit before tax. Is there. Look here, profit before tax is there. Profit for the period is after deducting income tax. Profit for the period we find. Profit for the period. Look here, there is a profit. Look, this one. Profit for the period. We find profit, this one, after deducting income tax. 2160. 2160 is profit for the period. We can find the income tax. I saw income tax is in the question. Look here, there is income tax. Look here, for the year ending 31st March 25. For the year ending means total one. Look here, the total income tax is there. Income tax expense 540 should be deduct. Profit before tax is top of there. After the deducting income tax, we can find the profit for the period. You must add this one to find the profit before tax. Why? At the calculation of profit for the period, income tax was deducted. Before deducting, you must add this. After that, you can find 2700. Okay. 2700 means profit before tax. 2700. You must be add to this one 3060 divided in 360. The answer is we find calculator. 3060 divided in 360. Answer is 8.5. 8.5 times. The 8.5 times is interest coverage ratio. 8.5. What is the answer? 8.5. 8.5 is the answer. 8.5 is third answer. There is a third answer. Interest turnover ratio is 6. Interest coverage ratio is 8.5. Answer is 3 for 24. After that we must find the answer of 25. In next video we meet 25 question.